So back in 2019, my wife and I bought a house for $500,000. We had $100,000 saved up for our down payment, that's 20%, and we borrowed the remaining $400,000 from the bank. Our interest rate was just about 2%, and this meant that over a 30-year period, we were going to pay back our $400,000 obviously, but just an extra $132,000 in interest over 30 years. So that's not bad. But if we were to buy the same $500,000 house with our same $100,000 down payment and borrow that same $400,000 from a bank with an interest rate going at about 5.4% today, we will have had to pay an extra $403,000 on top of the principal of $400,000 that we had originally borrowed. So in essence, we will have borrowed $400,000, but at the end of 30 years, we will have paid back over $800,000 in total. That's wild. And it's because of this wildness that I'm taking the time to explain interest rates, how they can affect you, and what you need to do to get the best interest rate for your situation. Let's go. Now, before we jump into the video, as usual, I have to give you a quick background about what interest rates are and how they work. So when you deposit $1,000 into your bank account, your $1,000 isn't just sitting there waiting for you to come and withdraw it someday. No, the bank is taking that $1,000 and the bank is lending out that money to other people. For example, to me that wants to buy a $500,000 house. The bank is borrowing money from someone, usually yourself, at an interest rate that you have agreed on when you opened your bank account and you deposited your money, and is lending that same money to other people at a higher interest rate. So when those people pay back, the bank makes some profits and the bank gives you your tiny little cut when everything is said and done. So now that's a quick background about interest rates, how they function in relation to you. So let's get into the meat of the situation and start to discuss why interest rates are so important now that you're looking to buy a house. If you've not watched the video about down payments and the video about mortgages that I made earlier, this would be a fantastic time to go check those videos and come back, because we're going to be using terms that we learned in those videos to describe things in this one. Watch them, come back, I'll be waiting right here for you. Now, before we jump into the video proper, I need to rehash certain things for people that want to watch this video to the end and then go watch those videos later. You heard me speaking about an amortization term. Now, this amortization term is a fancy word for the amount of time that it takes to pay off your entire mortgage. So your mortgage is consisted of your interest rate, or the interest you're paying on the principal that you borrowed. So for example, I borrowed $400,000. That's the principal. I'm going to be paying that over a 30-year period, and the interest that I pay for that $400,000 that I borrowed is about $132,000. So put all that together and I'm going to be paying that sum of money for 30 years, which is the amortization period. Now, every 5 years, which is a mortgage term, the bank is going to come back and say, hey, the interest rate that we locked for you, for example, we locked a 2% interest rate for you. That interest rate was locked for you for a period of 5 years. After 5 years, that interest rate expires. So we have to sit down at the table and renegotiate another interest rate based on what's going on in the economy, primarily based on what the Bank of Canada is saying about whether they want to increase or decrease interest rates. Now that you're aware of the terms that we're using to describe interest rates, let's jump into some very important things about interest rates that you must know so that you can get the best interest rate for your situation. Starting with types of interest rates. There are two main types. There's a fixed interest rate and there's a variable interest rate. Now, remember, a fixed interest rate means that you're going to be paying, for example, 2% over your mortgage term. So if you borrowed $100,000 and your interest rate is 2% and your mortgage payments, for example, are $2,000 per month, you're always going to be paying $2,000 per month for a period of 5 years before the bank calls you back to renegotiate a different interest rate based on what's happening in the economy today, or as at that time. Now, variable interest rates are kind of similar, but if within that 5-year period, the Bank of Canada wakes up and says, hey, we need to increase interest rates to, for example, 3%, you're going to be paying more money. And if the Bank of Canada wakes up tomorrow and says, hey, let's lower interest rates to about 1%, you're going to be paying less money. So, for example, in the fixed interest rate example, you're paying $2,000 every month. In a variable interest rate example, you can be paying $2,000 in January, Interest rates go up in February, you could be paying $2,500. Interest rate goes down in March, you can be paying about $1,000. It varies based on what it is that the Bank of Canada is saying interest rates should be for that mortgage term. So very important in selecting whether you want a fixed interest rate. A lot of people say it's peace of mind, or a variable interest rate where overall you might end up paying a whole lot less in interest, but always speak with your mortgage broker to determine what's best for your situation. Now let's move on to how interest rates affect house prices. And this is a very touchy topic, but let me break it down in the way I like to look at things and the way it has helped me in deciding when it was a good time to get into the market. In the real estate market, we have three types of markets. We have a buyer's market, we have a seller's market, and we have a balanced market. The buyer's market is a market where the buyer has all the power, and let me explain. So right now we're in a buyer's market because the interest rates are high. This means that not enough people want to buy houses because the cost of borrowing money to buy that house is really high. So finding someone to buy your house if you're a seller right now is a bit tough. Now, moving over to a seller's market, when interest rates are low, we normally see a seller's market because now the cost of borrowing money from the bank is low. So we have a lot of buyers struggling for the same house, which is why you start to see those record sales and higher in house prices and things of that nature. In a balanced market, the interest rates are doing okay. We don't have too many buyers. We don't have too many sellers. If you studied economics, it's kind of like an equilibrium type of situation. No one's rushing. No one's pulling back. Everything is pretty much chill. So as you can imagine, if the interest rate is high and someone wants to sell their house, it means that they are in a buyer's market. You're usually in a buyer's market. It means that they are the beck and call of anyone that wants to buy their house, because buyers don't want to go to the bank and borrow $400,000 and have to pay back an extra $403,000 on top of the $400,000 that they borrowed. So buyers are few and far, or far and few, or whatever, few and far between. And because a seller is trying to sell their house, they have to start to reduce the price of their house so that people can buy a lot easier. And if you've watched the mortgage video, this is where you start to see sellers giving something called a vendor take back mortgage, meaning that the buyer doesn't have to even go to the bank to get the whole sum of money that they need to buy their house. They just need to get some of it, and the seller will take care of the rest of the mortgage for them. This usually happens in a buyer's market. We're in a buyer's market right now, and if you have the available cash and you're ready to jump into the market, this is a perfect time for you to do so. So in a seller's market, the sellers have all the power. Interest rates are low, so everyone who is anyone can walk into a bank and get a good mortgage at a good interest rate. Problem is that there are also a lot more people out there who are in the same situation. So if you're in a seller's market and you're thinking of buying a house, keep this in mind. It's going to be a bit tougher to get a house. Get ready to bid and bid and bid and bid, but always be very careful. Make sure you don't overbid and get into a situation where you can't buy the house because no one wants to give you a huge sum of money for a house that's worth that small amount of money. Capiche? Interest rates have a lot to do with timing when to buy a house. If interest rates are high, house prices are usually low because not too many buyers. And if interest rates are low, house prices are usually very high because, well, too many buyers in the market and the sellers can afford to take 100 offers on one property and choose the best for their situation. Now, as usual, always remember to sit with a mortgage broker so that you can, most importantly, shop around for the best interest rates. So think of it this way. We're in a buyer's market right now. If you're trying to get a house, sit with a mortgage broker. Ask that mortgage broker to look for the best interest rates around so that you can reduce the amount of money that you're going to be paying over your amortization period. If you're in a seller's market, do the same. Try to get the lowest possible interest rates because you're going to probably be buying a house for a lot more money at that time, and they're looking to reduce the amount of money you're paying for the house, obviously through a fantastic realtor, aka me. Reach out, let's get you your house. And you're also trying to reduce the amount of money that you're paying in return for borrowing that money from the bank. So with that being said, but thank you very much for watching, and I'll see you in the next video where we talk about something as equally as important, your credit score and how it affects getting your mortgage lickety split. Thank you very much for watching. See you in the next one.